Hi, everyone. Thanks for joining and welcome back to Wall Street Silver. Joining us today is the founder of Adrian Day Asset Management, the man himself, Adrian Day. Thanks for joining, sir.
Well, thank you, Ivan. Hello, Jim.
Yeah, well, it's their second time on, so we're really glad to have you back. You said back in December that there's hardly any generalist fund that's basically holding any gold or going into gold until gold hits 1900. Now gold just hit 1900. Do you see or hear any funds going into it?
No, I mean, look, 1900 was, until gold exceeds 1900. And also, I mean, I don't think it's 1900. Okay, let's invest. It needs to stay above. And the problem right now, of course, I know we're going to get into it, is that we've had the last little move has been induced by the Russia-Ukraine situation, and so a generalist is probably going to look at that as temporary. But we'll say, no, but to answer your question, I haven't heard or seen any indication that generalists are moving into gold yet. But you won't see that until the reports start coming out. So we wouldn't see it for a month or two anyway.
Yeah.
Do you think, with all the chaos that's going on in Russia, Ukraine, the energy situation that it comes from that, supply chains, do you think that might give, I've seen just in the past day, some speculation from investment banks that the Fed may actually reconsider the aggressiveness of the hawkishness, the rate hike policies. Do you think anyone's sort of rethinking whether they can actually raise rates with all of this going on right now?
That's a good question. I mean, as we've talked before, the Fed going back to 2008 and even before then, but the Fed has basically, always found some excuse not to raise hikes. Brexit was the vote on Brexit, believe it or not, was a reason to pull back. Trump's election, China's economy. I mean, there's always some reason that they come up with not to hike. Mm-hmm. I think this time around, and let's face it, if the situation in Ukraine, Russia gets worse, that would almost, I hate to say it, be a valid reason to hold off. But the Fed has so much invested right now in terms of credibility, whatever remaining credibility they may have somewhere in the universe, not in this little corner of the universe. They have invested so much in raising rates that I think they would be hard pressed to back off.
The investment banks all seem to be saying between 4 at one end, and I saw JP Morgan recently said 9 rate hikes this year, which just seems, flabbergasted to me.
Yeah.
Do you have a sense of, how far they'll probably go at least?
It's to some extent, I think what's happening is these to firms like Morgan and Goldman Sachs, these are leaks from the Fed, and it's trial balloons to see what the market thinks. Now, the market isn't tanking because JP Morgan said nine rate hikes. I think the market is just saying, no way, Jose. Mm-hmm. But of course, if the consensus comes around to 6, 8, 9 rate hikes this year, and then they only do 4 or 5, that seems like a weak Fed to me. But there's no way they're going to raise hikes 9 times. It's just not going to happen.
We all keep thinking, oh, the market's going to crash if they keep doing this. But a lot of people say if you look at the individual stocks within the market, especially some tech sectors, the non-profitable tech sector, the market already has. I mean, the indexes are still high because of Apple and certain stocks, right, that heavily dominate the indexes. But you look at a lot of names, and I saw this one on Twitter. Tons of stocks are down, 2/3 from their highs. Has the market already crashed?
Well, that's an excellent point, and that's something that I've talked about. Is something I've struggled with in the investment management as well, because most, as you say, we can say this: most individual securities or stocks have already entered a bear market. So I think what we're more likely to see than, and when I talk about, well, sorry, let me back off. We may get on some event or another, we may get the index drop sharply for a short period of time. But in terms of what we might call a bear market that lasts 6, 9, 12 months or more, I don't think we're going to see that. I don't think we're going to see that precisely because of a reason you've said. But a lot of stocks have already entered this bear market. Now, having said that, let's not forget, but even the stocks that have dropped quite a lot are by no means trading at valuations typical of bear market lows. So a lot of stocks have dropped 10 or even 20%, and they're still fundamentally expensive. We shouldn't forget that. So I'm sort of, I guess I'm doing the two-handed investment manager here, aren't I? I think we're going to see rotation. We're going to see rotation out of the very high flyers into the more value stocks. But I don't think those value stocks, by and large, really represent very compelling value right now.
Yeah, I'm old enough to, Ivan's a young guy, he doesn't remember, but I'm old enough to remember the internet bubble when, 2001 to 2003, I think, Amazon lost 90% of its value. I mean, a lot of companies, very highly, richly valued back during the internet bubble, early 2000, just totally, fell off a cliff, and we haven't done that. Yeah.
No, that's an excellent point, and I'm glad you said Amazon rather than, whatever, dogeat.com that nobody's ever heard of. It was the big cap stocks, the well-known stocks, the real companies, they collapsed. And, I go further back than that to a period like 1966 to 1980, where the market did not gain at all, from 1966 to 1980. And a lot of people seem to think, they seem to have forgotten what a bear market's like, because we haven't had one.
What does an investor do right now in all this chaos? Are you a long short type? You can go short, you can go long in your funds, or are you strictly playing it from the long side?
No, we can go short, and we certainly buy puts or go short. The problem, we can. We don't have any shorts on at the moment. We haven't done shorts in any meaningful way since actually 2007. And some of them worked, some of them didn't. But I think it's a bit dangerous to be short at the moment when the Fed is still pumping money. Let's not forget that. All this talk about tightening and reducing the balance sheet and everything else. The Fed is not talking about normalization. Remember that word? In 2008, Bernanke said, well, this is all temporary and we're going to start normalizing soon. Nobody's talking about normalizing. In other words, getting the Fed balance sheet back to a level that is commensurate with the needs of the economy, and getting and letting interest rates go to the level where willing buyers and willing sellers, not government buyers, meet and at a normal interest rate. That's perfect graph. And so, first of all, the Fed is continuing right now. The Fed is continuing to increase its balance sheet. I mean, with all the talk that we've had for the last 9 months about tightening, you would have thought they would have started at least holding steady. They're not. They're increasing, even as we talk. Secondly, even with the most aggressive interest rate hikes that you referred to and balance sheet reductions that some of the Fed have talked about, like Bostic, the Fed guy from Atlanta, he sort of said, I think we could even cut the balance sheet by $1.5 billion this year. Well, look at the graph. So we're talking about the most aggressive, predictions or statements on what the Fed might do this year. And at the end of that, we will still have a balance sheet, even if they did the most aggressive, we would still have a balance sheet twice as much as it was last year, and interest rates more deeply negative than in the 1970s, at the dawn of the 1970s inflation. So this isn't tightening by any means. It's reducing the excessive ease.
That's a very good point. Here we are at 8.9 trillion. It'll probably be 9 trillion before they finally finish this paper and start to raise rates. So it'll be a milestone to remember. And we all remember, at least most of us remember, Janet Yellen saying it'll be like watching the paint dry right around here, right? And that didn't work for very long before we'll see. We're going to look back at this maybe a year from now and say, oh yeah, it was obvious to everyone how this was going to play out. But yeah, it's a big question mark right now. We think we know, but we don't really know. I want to get on to supply chain issues. And I know you try to avoid the politics side, so we're just going to stick with the supply chain issues of this. A lot of politicians seem to be picking fights with truckers lately, and I thought I'd just share this cartoon that I saw online today. What's your general take on this? Is this I know part of inflation is caused by several things. Monetary policy, probably number one, but supply chain is definitely an issue. What's your take on this? Is this a short term, or we're going to deal with this for another year or two, or what's your intuition here?
Yeah, I think the supply chain issues are temporary. Let's not forget, before COVID, all businesses were on just-in-time, supply chain, and firms didn't keep inventories the way they used to. And so a disruption has a much greater impact than, say, it would have done 20 or 30 years ago, because we're running just-in-time inventories. But I think the supply chain issue is something that can and will get resolved in a reasonable time. Now, Hutchinson Ports, which is one of the companies we own, I should disclose that, but I'm not necessarily recommending it or anything. Hutchinson Port Holdings, they hold ports, well, they own the Hong Kong port, and they also own ports in China. And so they should have their intuition on this should certainly be better than mine. And they think that the logjams of ports are going to continue well into this year.
So which sectors do you find most attractive? Are you looking at energy right now, precious metals, any other commodities, or is that the focus right now?
Yeah, certainly precious metals, gold and silver would be the number one. And they're the number one, not only because of the upside, but also because of the downside. I think on a risk reward basis, they are the best investments right now, by far. Now, we're looking at energy stocks, but the energy stocks to me have run up a little bit too far, too fast. So I'm waiting for a pullback in some of these. The one that I think people might want to keep an eye on, I'm not saying buy it today, but keep an eye on for a good opportunity would be Gazprom, because you look at Gazprom, I mean, that's a phenomenally, the Russian company, obviously, phenomenally profitable company. The current dividend is double digits. Of course, they were looking at oil flowing to Western Europe through the Nord Stream 2, and Germany's just said they're putting that on hold as punishment for Russia. That has to come back. It has to. I mean, Germany in particular and the rest of Western Europe need Russian gas. And if they decide they don't want Russian gas, Russia can sell that gas somewhere else without a problem. And in fact, interestingly, and I'll just point this out, sorry, we're getting a little off topic here, but after the news came out that Germany was going to hold the approval process, what happened to Gazprom? It went up $2.
Yeah.
Why did it go up? Because Gazprom has a long-term pricing contract with Germany. If they don't have to sell it to Germany, but can sell it somewhere else, they can get a better price for it.
Yeah.
I mean, the market's not always stupid. Sometimes it is, but not always. I do like other commodities, but most of the commodities, we're holding off buying right now for two reasons. One is they've had good runs. I mean, you look at Freeport. Oh, I shouldn't have said Freeport because I can't remember the numbers, but it's gone from somewhere like $30 to $44 in 6 or 9 months.
Wow.
You know, all of the commodity stocks, the uranium stocks, they've all had good moves recently, number one. And number two, you know, if the Russia-Ukraine situation gets worse, those commodities typically don't do well in that kind of situation. And you can see it in the last week. The commodities have moved contrary to gold and silver.
Mm-hmm.
When the situation is getting worse, you know, copper goes down, gold goes up. So I would just be a little bit, I'd wait for better prices on those. And then the last thing, I guess, is just looking for good value stocks. Now, this depends on the investor. If you're a long-term investor, not a trader, just a long-term investor, you want to build a portfolio of good quality companies, then look for some of those things that have dropped 10 or 20% that have great balance sheets and have dividends that you think will be can be sustained.
But you know what you just said about oil companies, and BlackRock is no longer investing in.
Well, this is Blackstone, but yeah,
or Blackstone.
BlackRock did it earlier, but
yeah. But at the same time, they're talking about it's politically untenable for them to invest in oil and coal, even more so. But they're also, we need these miners to go get some of these metals, whether it's cobalt, nickel, copper, silver, and they are blocking, you know, the green crowd doesn't want to let us mine for any of these metals that are necessary for the green energy movement, whatever that means these days.
Well,
So
I'm smiling.
Everything.
They're either hypocrites or ignorant. They're one of the two, because of just the reason you've said. I mean, we know this is well known now, but an electric vehicle takes 4 or 5 times as much copper as an internal combustion car. It takes 6 times as much nickel as an internal combustion car. So forget the lithium and the cobalt and the weird and wonderful metals from China and the Democratic Republic of the Congo. Anytime a country calls itself a Democratic Republic, you know it's got a problem.
It's a marketing issue, marketing name, right?
I mean, forget all those weird and wonderful things that are essential to electrification. Just look at copper and nickel and aluminum. I mean, how much steel goes into building those blasted, huge, ugly offshore windmills? Yeah. You know, it's a lot more copper and steel go into building, go into green energy than into coal-fired power stations. Yeah. You're absolutely right. So it's either ignorance or, I mean, Elon Musk, God bless him, he gets it. He knows he needs those things.
Well, you know, I saw an interview with Elon where he said, if I had a magic button where I could stop all oil and coal right now, I would not press it. He says, it's ridiculous. We're not there. He says, I would not stop oil. And he's, you know, Mr. Solar, Mr. Electric Car. And he said, we need oil and coal and natural gas. It would be ridiculous to halt exploration and consumption of fossil fuels right now. Everything would collapse. And when Elon says it, I hope more people will listen because he's got such a huge audience, but it's not penetrating. So anyways.
No.
But Mr. Adrian Day, I want to thank you very much for joining us. I know you only had a half hour in your schedule. We really appreciate you. The audience loves you. You have a great deal of wisdom. And we look forward to talking to you again in the next 3 or 4 months as the year develops.
Okay, I appreciate it. And next time it won't be a rant on the Fed. We'll do something different next time.
Yeah. Well, the ranting on the Fed is so popular. Though.
Yeah, we love that.
Yeah.
So
especially with
easy, isn't it?
It's so easy. Yeah. They're such an easy target. Yeah.
That's right.
Thank you.